Hey everyone, Chris Carr here. I hope you're having a wonderful start to the new year of 2023. We're already in February, and today I'm going to go through the February monthly market report. And I'm going to focus on five things here today. It's going to be mortgage rates, obviously. We're going to talk about housing supply or inventory. We're going to get into home prices, news headlines, and then we're going to end off with how to prepare for the time ahead and how to put yourself in a position to take advantage of the coming opportunities. So if you find any information in this video informative or educational, I'd appreciate if you shared it with 3 friends that you know, and also please like and subscribe. So I'm going to hop right into it here. Monthly market report for February 2023. All right. So people do not follow the best leaders. People follow the ones they can understand the easiest. Okay? They do not follow the best leaders, they follow the ones that they can understand the easiest. So, I'm going to go and do my best and explain some economic things that might be difficult and try to simplify those. So, we're going to start off with interest rates. This quote here, Ali Wolf, chief economist of Zonda. I wonder if some consumers have worked through the 5 stages of grief with higher mortgage rates. All right, so rates have been higher than most people's recent memory, especially if you compare that to the time where we went through COVID. And I want to go through and just kind of backdate and look at some historic rates here. So number one, I think the most important thing is that the mortgage rates are trending downward significantly. All right. Rates have gone down almost a full percentage point within the past 3 months, from just over 7 to just over 6 in about a 3-month period. That is wonderful news. Now I'm going to look at the projections for the 3 big players here with where they think rates are going from here. So pretty much the consensus is that rates will continue to go down for the rest of the year. I believe that as well. So next we're going to look at this kind of chart here. I think is pretty clever, but we're going to look at these 4 kind of stages of buyer demand and how they're correlated to interest rates. Okay, so we look at weak buyer demand when we were above 7 just 3 months ago, limited or little buyer demand above 6.5, but now we're kind of flirting with that 6 range, right? And this tells you that there's good to strong buyer demand. So good to strong buyer demand with rates under 6.5. So this is also good news. Okay, so mortgage rates. Next, we're going to head into the housing inventory topic, and we're going to look at new listings that are now below previous years, right? So we saw 2022 inventories rise. It's cyclical like it typically always is. From January to June, inventory or new listings rose, but at a lower pace than it had in the past, okay? So then we look, where does that head? Does that kind of taper off? And did that result in some pent up inventory? Well, unfortunately, with interest rates going up, that answer was no. So we had a pretty big decrease in listings, as it is typically a cyclical. If you can look at the past 6 years here, but it was more significant than any other year in the past 6. So low amount of buildup and a steeper decline. All right, and that's going to result in a little bit of lack of new listings and inventory. But let me put it into context. So we look at the new listings now below previous years since January 2017. Okay, listings are below average where they should be. If I was an agent out there, a home buyer, home seller out there, listings are still low. I would really contemplate seriously buying and selling between now and September of this year, as more listings are going to come to market. Okay, as they have every year almost, at least through that chart last 6 years, as they do almost always. Now let's go back and look at the months inventory over the past 12 months. Okay, we look at The month's inventory, and again, remember 6 is about a neutral market here. Okay, so we've been under a seller's market for quite some time. All right, so month's inventory of home sales over the past 12 months, yeah, they've gone up quite a bit. But let's back this down to 2019. All right, we look at months inventory from 2019, almost half of this time period is above where we are today. All right, I've made this analogy in the past. It's like we're racing down the highway at 100 miles an hour over the past 2 years, and now we slow down to the speed limit. It feels like we're going so slow, but in reality, we're still going a little bit faster than the speed limit, okay? Then let's take this back even a little bit further to 2011. We look at months inventory of homes for sale from 2011 to today. You can now put it even in more context. That little blimp of inventory going up is marginal compared to what it was in 2011, 12, 13, 14, 15, 16, 17, 18, right? Still below those numbers. Now, this quote here, I'm looking at the latest housing data and I see surprising demand indicators, including home price resiliency and supply staying restricted. Who would have guessed that, right? Everyone thought a big crash was coming, or a lot of people did. We've been able to absorb that, and don't bet against the U.S. economy. It's a strong thing, at least the U.S. market. The economy, we'll see how those factors can impact forecasts in the future. But let's jump over to home prices. Okay. So percentage year over year, December 2022. The forecast from CoreLogic was 3%. In actuality, the year over year change was almost 7% growth. Okay. Now we look at big banks beginning to revise their forecast. We've got Goldman Sachs here dramatically changing their home price forecast for negative 6% depreciation, going down, to just a couple weeks later adjusting that forecast to 2.6. So we think really it's going to be probably a pretty flat year, plus or minus 0. Okay, some markets will still increase, some markets will decrease, some more than others, in both up or down. But overall, generally thinking here, it's going to be pretty much a flat year. If we look at the changes in home prices year over year, the 20 city composite, yeah, like I said, we were going 100 miles an hour even in this part of this year, April, May, March, June, July, December, January, 20% on average. We're still going at 6.8% in November. That's above historic averages. So yes, we were going super fast, crazy, unheard of type of appreciation and increases in home prices. That's slowed down, but it's still higher than normal. So that leads me to the next question: have home values hit bottom? Have home values hit bottom in these negatives for the 2022 month-over-month percentage change in home values from the 4 large indices here that track this? So that's a real question to consider. Have housing prices hit bottom in this, where we're at in this current cycle? Again, I think maybe the next 9, 18, 24 months, depending on what happens with the economy, jobs that could possibly lead to a recession, that may change the values a little bit. But remember, in almost every recession besides 08, 09 for the past 40, 50 years, there's still been an increase in home values. What I think would impact this the most would be interest rates, as one of the key and only ways to get out of a recession is to stimulate growth. To stimulate growth, you lower the cost of capital, which is your mortgage rates, your interest rates, and your Fed funds rate. So if we do go into a recession in the future, rates will go down even further. Okay? Last 2 topics here, we're going to go about the headlines that terrify more than clarify. So 67% of Americans think we're going to have a housing crash, and it's imminent within the next 3 years. Foreclosure filings have surged 115%. They've doubled annually. Let's take that into a little bit more context, okay? So the leading curator of real estate data, Adam, nationwide for land and property data, released a while back, a couple months ago, or a couple weeks ago, year-end foreclosure market report, which showed foreclosure filings, default notices, scheduled auctions, and bank repos were reported on about 325,000 properties in 2022. That is up 115%, more than double from 2021, but it's down 34% from 2019 and down 89% from 2010. Okay, let's put this on a chart. So US foreclosure activity doubles annually. It did. You look at the bottom corner over there, 2021, 2022. So it did double. However, it's below 2019. Okay, below pre-pandemic levels, and in larger context, significantly, almost 10 times lower than what it was in 2010. Okay, you look at the percentage of distressed property sales, 1% of sales in December. So still extremely small number. And I did a video on this a while back. I used to buy distressed properties from the foreclosure auction in 13, 14. So 2012, 2013, like right in the height of this, I used to buy properties at the auction for a hedge fund. Not seeing anything like that whatsoever with these pre-foreclosure lists. And then one final chart here, I think 1 million fewer foreclosures over the last 3 years compared to the historic average. Okay, so hundreds of thousands every year short, totaling up to about 1 million fewer foreclosures over the past couple of years, right? So there's a lot of room to absorb here. Last two slides here before I get into the finish. 18 months after the end of the government's foreclosure moratorium, with less than 5% of the 8.4 million borrowers who entered the CARES Act remaining, foreclosure activity remains significantly lower than it was prior to the COVID-19 pandemic. It seems clear that the government and mortgage industry effort saved millions of foreclosures. Okay, the bottom line is there will be an increase in foreclosures over the next year, probably a couple of years, from absolute record levels. But there will not be a huge wave of distressed sales as happened following the housing bubble. It's just not there. There's still net household formation growth. There's the key economic indicators just don't make sense for that. The distressed sales during the housing bust led to cascading price declines, and that just will not happen this time. So we must control the narrative, okay? The other thing we must control is our businesses and our household wealth. We are looking at this period of time like a turn in a racetrack, all right? It started in the middle of last year. It's gonna go to the middle of this year. This is where careers, where wealth is built, realtor careers, loan officer careers, investment careers are made in the turn by decelerating, by planning, by hedging, and getting in a position to be able to accelerate fully as soon as you're able to get that angle out of the turn and hit the straightaway, okay? So the smart realtors, the smart mortgage professionals, the smart real estate investors, the smart home buyers are positioning themselves right now to make a generational change of their family tree, of their careers and businesses over the next 6 to 12 months, okay? So this is an opportunity to look through what areas you should be going after. If it's your credit repair, if it's a job stability, if it's investment options, if it's talking to realtors, expanding your network, if it's going through your past database and looking at areas where we're sitting on so much equity. If anyone's bought in the past 2 to 4 years, or if anyone's bought in the past 6 months, now's a good time to explore a refinance with rates going down 1%. So it's time to prepare like we're in the turn of a racetrack, and we're going to take advantage of the straightaway, which could be a life-changing series of events depending on what you're really wanting to do. So that concludes the monthly market report. It says January, it meant February. For February 2023, if you have any questions, mortgage related whatsoever, or real estate or wealth related whatsoever, please let me know. Again, like and subscribe, share this video with 3 people that you know. And if you know anyone looking to buy, sell, or refinance, please send them our way. Thank you. Bye.